All right, let's get into the topic of this podcast. I called it retirement accounts versus real estate, but it was triggered by this email I got who said, I know you're familiar with the semi-retired MD program to advise, teach MDs on real estate investing. They're actually pulling money out of 401k, etc. I contribute $75,000 plus a year, closer to $90,000 maybe, to retirement accounts. I'm faced with the dilemma of not contributing to the cash balance plan in order to use the money for real estate investing. Honestly, that sounds crazy to me. It's a huge tax savings up front that I doubt can be regained even in smart real estate investing. What are your thoughts on this? And I do have some thoughts on it. You know, I always worry when someone's being told to take money out of retirement accounts before they need it to spend in retirement, or before they're required to by the government as a required minimum distribution. It always makes me worry that you're being sold something. You know, I think the classic example is this guy I blogged about a few years ago. He was calling it missed fortune back then. I think he's calling it live abundant now, but he's a local guy here in Salt Lake City. And basically his philosophy is borrow all the equity out of your homes, pull all the money out of your 401ks and buy universal life insurance with it, you know, index universal life. That was the whole philosophy. And of course, he's getting these massive commissions on these huge universal life policies. And you wonder, well, why is he telling you to do that? Because that's the only place most people have money is in their retirement accounts and in their home equity. And so I think you need to be a little bit wary anytime you see somebody recommending something against something that is so beneficial to you, like retirement accounts are for doctors. And they're even more beneficial to doctors than they are to most people. But I totally understand too that real estate investing is really attractive to people. It's a great asset class. I invest in real estate. 20% of my portfolio is in real estate. It's got a lot of benefits. You know, the returns are solid. The correlation with your stocks and bonds is low to moderate. There are some unique tax advantages, mostly depreciation that can be passed through to cover that income from the real estate so that it can be tax-free income sometimes if it's structured properly. You know, there's lots of benefits to real estate. I think a lot of doctors got a little bit scared this spring when they saw their paychecks go down or they didn't get their raises or they were asked to take time off they weren't planning on taking off and started really looking at side gigs and passive income kind of stuff a little bit more seriously. And so I kind of get what the attraction is there. That said, I never invested anything in real estate until I had at least outside of retirement accounts, until I had maxed out my retirement accounts. I think those benefits are so huge for doctors that I wouldn't pass them up. I mean, there's not only the big tax benefit, right? Just having tax protected growth on that money, not only for the rest of your career, but for 20 or 30 or 40 years in retirement is massive. It is a huge benefit to be able to not pay taxes on your dividends and interest and capital gains as that money grows. But in addition to that, most doctors, maybe not the super savers of you out there, but most doctors are going to save money at a much higher tax rate during their peak earnings years than they are going to pull that money out at in retirement. Because remember, when you pull that money out, for most doctors, those tax-deferred retirement accounts are going to be a large part of your taxable income in retirement. And you can use that to fill the brackets. You know, if you're married, the first $24,800, the standard deduction that comes out of those accounts every year is tax-free. Then you get another $19,000 that comes out at 10%, another $50,000 that comes out at 12%, another $75,000 that comes out at 22%. I mean, that arbitrage between the tax rates is super, super valuable as well. And that's why I'm very hesitant to tell people to pass up contributions to these retirement accounts, no matter what the investment's going to be that you invest in otherwise. It has to be a heck of an investment to make up for that. But wait, there's more, right? What else is a retirement account good for? Well, it facilitates your estate planning, right? All you have to do is name a beneficiary. No need to hassle with trusts. That money doesn't go through probate. It goes immediately to your beneficiary when you die. And while the stretch IRA has been a little bit neutered as of late, you still get a stretch. Your heirs still can stretch that money out for 10 years. And actually don't have to take any required minimum distributions in those 10 years. And so retirement accounts have these great estate planning features as well. But one feature that matters a lot to doctors, and maybe it shouldn't matter as much to them as it does, but doctors are all terrified of being sued above policy limits and losing everything. In most states, your retirement accounts, your ERISA protected ones, the 401ks, as well as your IRAs, receive substantial asset protection. In many states, even if you had to declare bankruptcy because of some crazy 1 out of 10,000 suit above policy limits, you had to declare bankruptcy, you'd still get to keep everything in your retirement accounts. And while you can try to protect, real estate with LLCs, et cetera, outside of retirement accounts, that protection is not nearly as good as what is afforded retirement accounts. So between the tax benefits, the estate planning benefits, and the asset protection benefits, I really would not pass up on retirement account contributions in order to invest in real estate. So what are your other options? Well, ideally, you're saving so much that you can max out your retirement accounts and still invest in real estate. That's actually pretty easy for a lot of docs because they don't have great retirement account options. Maybe an HSA isn't right for them, so they got a backdoor Roth IRA, maybe a spousal backdoor Roth IRA, and maybe a 401k. That's not uncommon for many employee docs that that's all you have. And if that's the case, well, it shouldn't be hard to invest above and beyond the retirement accounts because you need to be saving 20% of your income and you can't get 20% of your income into retirement accounts. But if you got some huge cash balance plan available to you, that becomes a little bit harder. If you're able to put $100,000 or $200,000 a year into retirement accounts, it can be tough to save more than that on a physician income. And so I empathize with you there. But there are other options above and beyond that. For example, you can just invest in real estate inside your retirement accounts. Most of you know about real estate investment trusts. Maybe most of these are publicly traded, right? They're traded on the stock exchange, and you can buy them in a mutual fund just like you can any other stock. And you can just go buy the Vanguard Real Estate Investment Trust Index Fund, and you can buy that in your IRA, or maybe it's available in your 401k, and you can get real estate exposure in your portfolio using that. There are other real estate companies. There are other real estate funds. TIAA has a real estate fund we'll talk about a little bit later in the podcast. But you can just buy publicly traded real estate inside your retirement accounts. That's relatively easy to do. If you want to buy private real estate, you can do that inside retirement accounts as well. However, they have to be special retirement accounts. They have to be self-directed retirement accounts. It's relatively easy to open a self-directed IRA or self-directed Roth IRA. If you have an individual 401k, you can get a self-directed individual 401k instead of just opening a cookie cutter one at Vanguard or Fidelity or Schwab or wherever. You can actually hire a company to basically write the plan document correctly so that you can have that feature in your 401k. My 401k right now, the White Coat Investor Individual 401k, has got that feature. We haven't actually used it, but I told them to throw it in there when they designed the plan. I needed some other features that I needed a customized plan for, primarily mega backdoor Roth IRAs. But our plan has that feature. It's not that hard to get. So if you are using an individual 401k, you can just set it up so that it allows for self-directed investments like that. That's a great option. You can even buy individual properties. You want to buy the house down the street and rent it out? You can do that inside your self-directed IRA or self-directed 401k. Just keep in mind that every dollar that goes into that property has to come out of the retirement account, and every dollar that comes out of that property has to go into the retirement account, right? You can't mix this with your personal assets now. So it's a little bit more complicated that way, but it is something that can be done. You do need to be a little bit careful about unrelated business income tax. This applies in a self-directed IRA, but not a self-directed 401k. But basically, if that property is leveraged, you may end up still paying taxes, even though it's inside your IRA. So learn about those rules if you're going to have a leveraged property inside a self-directed IRA. So here's another option, right? If you're really into real estate, you took this semi-retired MD course and you really want to get started, but all your money's in retirement accounts, well, here's another option. You can take a 401k loan. You can borrow the maximum of either $50,000 or 50% of the balance, I guess whichever one's lower, from your 401k and use that as a down payment on a property. and then you can slowly pay back your 401k. It has to be paid off over 5 years. Remember, if you separate from the job, you have to pay that back within by the time the next tax day rolls around. So if you borrow the money in January, you got to have the money back into the and you quit, you got to have the money back into the 401k by the next April 15th, unless you file an extension, then you have till October. So that could give you, quite a few months, up to 21 months of being able to use that after you quit a job. But if you stay with the job, you got 5 years to pay it back. So that's an option. The last option, of course, is just withdrawing money from your retirement account. I don't think that's a good idea. That is a big tax hit for a working doctor because you're going to pay at your ordinary income marginal tax rate. For most of us, that's 32%, 35%, 37%, something like that. Plus, you got to pay a 10% penalty. So you might be pulling that money out at 40 or 50% effective tax rate. That's not a good deal. It's got to be a heck of an investment to do that. I guess it's a little bit worse than not contributing at all in that you then have to pay the penalty. But they're both pretty bad. So I would still try to max out my retirement accounts and invest in real estate in addition to that, if you so desire. Remember that real estate is optional too, right? Many doctors, including myself and the physician on fire, became wealthy, even financially independent, doing nothing outside of boring old index funds invested mostly in retirement accounts. Even now, only 20% of my portfolio is in real estate. It's just an asset class. It's a good asset class, but it's just an asset class. Don't put it on some pedestal that it doesn't necessarily deserve, like many real estate gurus, books, blogs, and courses do, especially if you actually like what you do and are willing to work a reasonably long career. Now, if you're trying to become financially independent in 6 years or something out of residency, you're probably going to need to take a fair amount of risk, both entrepreneurial risk and leverage risk and that sort of a thing that real estate can help you with. But if you're okay with a typical 20 or 30-year career and saving 20% or so of your gross income, you will get to financial independence without ever touching real estate. Okay, so I hope that makes it clear on how those two factors can mix together for you.